All eyes are on what the Federal Reserve is going to do this week at the FOMC meeting concluding Wednesday. The market is pricing in no rate hike in response to CPI numbers released today by the BLS. We'll talk about that with Sam Burns. He is the chief strategist at Mill Street Research. Welcome back to the show. Pleasure hosting you again, Sam.
Oh, no, appreciate it. Thanks for having me on, Dave.
So CPI released today, 4% exactly was the headline CPI number. This is in line with the expectations of 4.1% was the consensus expectations. And so the markets were, well, we'll talk about why exactly you think the markets are rallying, but the moment it was released at 8:30 a.m., the probability of no rate hike shot up to 98%, according to the CME data, the CME Fed Watch tool. So are you in the 1%, 1.5%, or the 98%?
I think I'm in this one. I'm with the majority. I think there's probably going to be no rate hike tomorrow. I think the Fed definitely does not want to surprise the market in that way, and they've been telegraphing a pause for a little while now. There was nothing sufficiently shocking in today's data that would push them off of that. So I doubt that they would try and surprise the market like that.
As we're speaking right now, around 1 p.m. Eastern time, the S&P is up about 70 basis points. The Nasdaq's up about the same. And so my question is, are the stock markets responding positively, semi-positively to the CPI read, which is also an implication of no rate hike tomorrow, or are they responding to something else?
I think the stock market is glad that there were no surprises. I think that's always the trick. Everyone gets a little nervous ahead of these reports and is afraid that there'll be some sort of big shock surprise that will then cause dislocations. And we didn't get that. Everything was reasonably benign and more or less in line with expectations. So I think you can sort of take off those hedges and things. And if you expect nothing to happen really tomorrow, then you're back to just looking at earnings and other things that have been relatively positive for the equity market lately.
Yeah. Let's talk about the breakdown of the CPI. So a lot of Americans are complaining that their grocery bills have been high, much higher than 4%, which is why they've been skeptical of actually accepting the government numbers of the CPI report. But actually, if you drill a bit deeper, if you look at the food component, we'll put a chart on the screen, but the food items as reported by the CPI report, those actually showed much higher year-to-year increases than 4%. And so it makes sense that people's grocery bills have been higher than, or the growth in the grocery bills have been higher than what's been reported in the overall index. If you look at shelter as well, which includes rent and rent equivalents, that's been going up in a straight line. And just this report, it's gone down by 0.1%. It was 8.1% last month. Now it's 8%. So my question is, Sam, can you really say that for most Americans, inflation has come down if rent is still going up by 8% a year and food is still going up by much higher than the average index overall of 4.1%?
No, I think you're right. Those are things that a lot of people are kind of focused on, think about a lot. I think there are 2 points to make there. The biggest one is that for shelter costs, which is a little over a third of the CPI in total, current market rents and housing prices are not going up at an 8% annual rate right now. And certainly over the last, say, 3 to 6 months, most of the other data that you see shows rental and housing prices at much lower growth rates or even no growth rate over the last, say 6 months. And what you're seeing in the CPI is a reflection of the way the CPI calculates rent, which is to look at the kind of the average over the last, say, year. They're assuming that most people don't sign a new lease every month, essentially, and which is true. And so the average rent is kind of a lagged reading on what current market prices are actually telling us, whereas other readings from Zillow or the apartments list or even the BLS itself has some data showing current market rents. Those have stopped growing over the last, say, 6 to 9 months. And so I think the actual rate of growth of housing has really slowed down quite a bit, but it has not shown up in the CPI yet because of the way it's constructed. And that's been the case all along. The CPI hasn't changed. That's just the way they've done it to make it more like what the average consumer experiences, which is fine. It's just not as useful for forward-looking purposes or saying what's happening right this minute. And then on the food topic, food prices have certainly gone up, but even more recently it's been a split between food at home, the food you buy at the grocery store and eat it at home, versus food at restaurants, food away from home. The food away from home is still going up pretty rapidly, even in recent months, but food at home has slowed down the last few months. There's been a lot less inflation there. And I think that's again because food away from home in restaurants is driven by labor costs and rent costs and things like that more than the cost of the food itself. Whereas the food itself has actually moderated quite a bit just in the last few months. So I think you'll see that sort of slowly reflected in the CPI as it kind of catches up to that. But you're definitely seeing a split between what's happening recently and what the CPI is kind of showing in some ways.
I mean, you're right in that food overall, the inflation of food overall has come down somewhat. And certainly, if you look at something like the UN Food Price Index, that's been rolling over for months now. Agricultural products have been going down. But if you take a look at food at home items, like grocery items, flour, for example, cereals, they're still growing at double-digit rates. And so my question is, why is it that certain food items are still very much sticky upwards? Why can't food just fall? My grocery bills just fall at the same pace as everything else.
Yeah, no, you're right. And it is, I think, a difference between the underlying commodities of food, the actual food itself has been stable or falling recently. But the packaged goods, the things that are processed by, big companies and put on the shelf, in a package and all that, those have not seen the same kind of declines, partly because the packaged goods price companies have not been forced to. I mean, consumers are still buying them, so they'll keep their prices up as much as they can and help their margins. And they have seen better margins. And some of it is just that those things move more slowly. The pricing of a lot of packaged goods doesn't change, as quickly as commodities do, in terms of the raw underlying, things you buy in the vegetable aisle. So I think there's some lags involved there, and also the fact that the packaged goods companies and places that at the grocery store that provide those items are just slower to change their prices and tend not to cut prices as much as you would for an underlying commodity.
So what's your overall read on headline inflation? Is it still trending downwards over the remaining of the year?
Yeah, I think so. I think some of what we're seeing right now is the fact that some of the data from the first half of 2022, when prices were really going up, then is still in the data a little bit. As we drop that off, the rolling 12-month window will drop out some of those really high readings from early 2022. And the other thing is, I think that generally the price pressures are easing in general. You see that certainly in energy prices and anything tied to energy prices, but a lot of things have slowed down. Most goods prices, aside from food, the sort of standard things you buy in a store, most of those have really slowed down quite a bit in terms of growth rate. It's really only in services and things that are tied closely to the labor market. So travel, entertainment, restaurants, things like that are where you still see some of the price pressures. So it's much more of a mixed picture now than it used to be. And I think that'll continue to slow, both from the effects of the Fed rate hikes and from just the labor market stabilizing over the next 6 months.
So let's talk about energy briefly. Energy has been the component that has seen the biggest decline in the CPI index this report, with fuel costs coming down by 37% year over year. How much of this decline was simply due to the base effect because energy has gone up so much the previous year versus energy signaling a slowdown in the economy?
Yeah, well, and there's definitely a base effect from earlier last year. Of course, the war in Ukraine that started in February last year pushed oil prices and everything else up dramatically through about June of last year. And so now we're seeing the year-on-year comparisons from those kind of spike levels really roll off, and you're seeing big year-over-year declines now. So that's certainly a benefit. The fact that oil prices have come all the way back down to at or below where they were before Russia invaded Ukraine, and have withstood several supply cuts from OPEC, which has been trying to boost oil prices and so far been unsuccessful, I think tells you that there is an underlying demand issue as well, particularly from China, where growth has been much weaker. They're trying to stimulate their economy, and overall demand in the U.S. and Europe for oil has been weaker, partly due to efficiency and electric cars and things like that. So I think there's a demand component. And then supply has picked up as well. The U.S. is producing, more oil than it was last year, so that's helped balance out supply and demand. Same thing for natural gas, has come down quite a bit. So a lot of those things have seen supply improve, and demand has been relatively muted. So you've seen the energy prices come down pretty dramatically, and are really a beneficial offset to a lot of the other inflation pressures.
According to the EIA, the Energy Information Administration of the U.S., as of 2022, gasoline expenditures accounted for roughly 2.6% of disposable personal income. Do you think that gasoline prices, then my question is, do you think that gasoline prices coming down, at least from last year, will incentivize Americans to spend more on the periphery?
I think so. I think some of what we're seeing in terms of people spending on services, going out and doing things is partly because of lower fuel prices, lower gasoline prices. They're spending less on, natural gas at home or fuel for their cars, so they can go out for drives or they can travel more. And certainly demand for travel, it remains very high. So I think that is a big benefit. And yeah, I think the focus on gasoline prices, certainly by the U.S. consumer, has always been sort of overstated relative to its actual impact on overall spending or the percentage of their income that's spent on fuel. But it's a very kind of salient price. You see the price of gasoline everywhere whenever you drive around. It's one of the few prices you see daily, and it changes daily sometimes. So it gets a lot of attention, but it isn't really that big a portion of the overall paycheck. But I think it is helping overall spending in other areas hold up better.
One thing that I've noticed is the dramatic decline in advance retail sales. So if you take a look at retail sales as a percentage change from a year ago, the latest reading is actually 0.5%. Now, keep in mind that at its peak in 2021 April, retail sales grew by 46%. It's been steadily coming down, but it was double digits for a while, the growth that is, until now it's basically no growth from a year ago. If this trend continues, we're going to get negative growth. How much of this is due to inflation coming down, and so the relative price changes of goods actually being bought, that's coming down versus people actually just in volume terms spending less?
I think a fair amount of it is probably the inflation, pressures receding, particularly for goods in stores. So, like I say, the things you go to a store and buy off a shelf, a lot of them have really seen their prices rate of growth slow down, and that's bringing their growth rate of retail sales down. There's also, of course, there a base effect. As you mentioned, it was very high earlier and it's slowed down. So overall, retail sales are still high at a level basis, but the growth rate has slowed down quite a bit. I think some of it is the what people are spending their money on, kind of the relative change, and some of it is the fact that prices are not going up for a lot of those things, and some of that includes gasoline spending. Fuel prices are coming down sharply, influences that headline number as well.
What I don't understand is how advanced retail sales, or retail sales overall, have been coming down on a percentage change basis, yet credit card debt has continuously gone up. So if you take a look at data from the New York Fed, for example, they've reported over $900 billion of household credit card debt, the highest on record, projected to surpass $1 trillion soon. What are people spending money on the credit card if retail sales are down?
Well, I think a lot of it right now winds up being not only going out to eat, but also Taylor Swift tickets and travel and entertainment. A lot of the companies that show up well in the stock selection work I do, that's based on analyst estimate revisions, shows a lot of those kind of companies, hotels, resorts, airlines, all those kind of things, seeing big increases in demand and in earnings. And the same thing is true for housing. I mean, the fact that housing stocks are doing very well right now and are showing their earnings estimates go up, even though mortgage rates are up at 6.5% or 7%, tells you that there's still spending power out there, and that's what it's going to. Some of it is going to housing, and some of it is going to kind of the travel and entertainment stuff that people couldn't do for so long after COVID. And so they're spending less on goods at the stores to some degree, and more on entertainment and services.
All right, we're going to come back to your sector outlook in just a minute, but let's close off on the Federal Reserve. If you take a look at the probability of a hike in July, data from the CME Fed Watch tool, the probability of one hike of 25 basis points is 60% in July. So markets are pricing in a pause, what many people are calling a hawkish pause. And I guess that hawkishness will translate to the next meeting when they might hike according to data. First of all, are you in that camp that they're going to hike one more time in July?
My guess is they'll probably find a reason not to, but I think that they will keep up the hawkish messaging certainly tomorrow and after that. I think they're going to say, core inflation at 5.3% year over year is still too high. We may have more work to do. The things they've been saying recently, the inflation fight is not done. All those kind of things I think they'll continue to say, and that will keep the door open for a rate hike in July. And again, because some of the other central banks, Bank of Canada, Reserve Bank of Australia, did exactly that. They paused for a meeting or two and then raised rates here in June just recently, after seeing data that kind of surprised to the upside a little bit. So I think they want to leave the door open for that, and the market is willing to kind of leave the door open as well and keep a 50-60% chance of that happening. My guess is they'll probably avoid it, but it's kind of a coin toss at this point. But overall, I don't think it makes a big difference whether this is the last hike that we've seen last month, or whether July is. I think most people view we're close to the end of the rate hike cycle, and that's really what matters for markets overall.
A lot of CD rates, or short-term money market rates in the U.S., are being offered at 4.5%. This is for the first time, I believe, for the first time since 2 years ago, that short-term money market funds are higher than inflation. So I guess could you make the argument that right now all you have to do to beat inflation is to put your money in cash and short-term treasuries?
Yeah, no, holding cash and money market funds certainly looks a lot more appealing now than it has for many years. After a long stretch of zero rates and rates below inflation, you're finally getting, excuse me, some positive, real short-term rates. And I think that is, one of the reasons why I think, there's a certain tendency to assume that investors will take that and say that, cash looks more attractive now, and not want to buy stocks. But I think really the argument is that longer term bonds that yield actually less than that are sort of unattractive in some ways, because they're giving you less interest and have already priced in some of the rate cuts that might come next year. So I think cash is more attractive than longer term bonds, but I think that equities have earnings growth behind them now, and that's making them more attractive than cash at the moment.
Yeah, let's talk about the earnings season. Can you recap what's happened so far and whether or not most companies have beat expectations?
That's right. I think the first quarter earnings reports that came out, April and May, really kind of turned the corner, I think, for a lot of people and a lot of analysts who had been very negative on the earnings outlook overall, most of the second half of last year and early this year. I think a lot of people were expecting that the Fed tightening was going to push earnings into a sharp recession. The earnings were going to be down sharply and would continue to decline. And what we've really seen is that earnings have come down, and certainly estimates came down quite a bit last year and early this year. But now they've stabilized and actually starting to turn back up again. And so I think whatever amount of damage the Fed has done, at least in an immediate sense, has been done for now. And the fact that some of that is now going to stabilize, rates have been stable, and companies are adapting to the current environment, means that earnings are going to be at least stable or maybe grow somewhat, which is definitely was not the consensus even a few months ago. I think the stock market is now adjusting to that new kind of less negative consensus, and the analysts are responding by raising estimates, or at least stopping their cuts, which is what we've seen in the last couple of months.
Okay. The valuations of some tech companies, talking about NVIDIA, for example, have skyrocketed following earnings beats. Do you think that these moves were justified?
In some cases, certainly earnings were a lot better than expected. And some of the earnings have really gone up quite a bit for some of those companies. Now, whether they fully justified the valuations or not, it's hard to say. There's definitely some that look like they're pretty aggressively valued, depending on what you think about the underlying drivers. But I think the general trend toward growth stocks that we've seen, makes sense if you think that the Fed is probably done raising rates and that bond yields are more likely to fall than to rise. That's typically, slowing growth, falling interest rates. Those are typically conditions when growth stocks will tend to do better. And if you have an earnings tailwind for some of them, certainly a lot of those AI-related names, and even a lot of software names are seeing some of the strongest analyst estimate activity in the work that I do. So that's basically a fundamental reason for some of them to have done well. But some of it is also people looking for, in some ways, a safe place to put their money. Some of those big cap tech stocks are considered, safe hands. No one's going to argue with you for owning some of those big names in conditions like this. And so I think if you have money to put to work, that's the first place people look. And now it's starting to broaden out a little bit. Some of the smaller caps and cyclicals are starting to do better, and the financials are stabilizing. So you're getting a little bit better kind of breadth in the market than we saw over the last couple of months.
Okay, let's talk about the labor market for a minute. The unemployment rose by 0.3% in May to 3.7%, according to the BLS. This is a slight increase, but 3.7% is still low by historical standards, even compared to 2 years ago when it was near 6%. And so my question is, how many consecutive months of increase do we have to see before you can definitively, as an economist, make the conclusion that the labor market is in danger?
Right. No, I think you definitely got to look, beyond just the headline unemployment rate to get a really clean view of what's going on in the labor market right now. And it has been very noisy and very sort of messy in the data, certainly on a month-to-month basis. As you know, there are two surveys of employment. There's the establishment, where they ask companies how many people they employ. Then there's the household survey, where they ask people if they have a job or not. And they will give different measures, in different months. And so last month, we saw the unemployment rate rise, even though the number of people employed rose substantially. So some of it is kind of the measurement of who's really in the labor market, who's looking for a job versus not looking for a job. There's been a lot of people lately who have gone from being not in the labor market, not looking for a job at all, and completely, off the unemployment rate, to going straight into a job and not being unemployed first. And that's fairly unusual historically to see a large number of people doing that. But that's kind of skewed the data a little bit. So I think the labor market overall is still pretty strong. It's definitely not as strong as it was, 6 months or a year ago, but that was an extremely strong labor market. And so you can't really sustain that. So I think when you put all the data together, the unemployment claims, the monthly job increases, unemployment rate, all those data all together still show a pretty good labor market, just not quite as strong as it was, a few months ago. And that's kind of what the Fed wants to see. It wants to see things slow down a bit, and the growth of the labor force itself is not that strong. So you're going to kind of run out of people to add to the labor market soon. So I think it's pretty strong still, and that's what's holding up consumer spending so far.
Can we see a scenario in which the unemployment rate rises dramatically in 1 month, not over a period of not 1% or 2% over a period of 6 months, but perhaps 0.5% to 1% in 1 month's reading? Is that possible this year?
I mean, certainly it'd be possible. I wouldn't expect to see that in the next few months, at least. Typically, that would happen. Something like that would happen as you get further into a down cycle. Things will have already started to deteriorate before you see the really big increases in an unemployment rate like that. You typically wouldn't see that right at the very beginning of kind of a unemployment cycle. So you're right. Once things start to really turn the labor market, it's kind of a bit of a battleship. It moves slowly, but once it turns, it tends to keep going. And so I think we're not there yet, but we could get there maybe next year. You could see things like that. I think for now, you'll see some noise in the data still. So you could see some a 1 month number that looks worrisome, but I don't think the overall picture is going to change that rapidly right now.
Well, I think people are just concerned about job security. So you're saying that we're going to see a rise in unemployment once the economy already deteriorates to a point where that's to be expected. So what other signals or indicators can we expect to see before that happens? In other words, what can the average American expect to see in the economy before they should really be worried about job security?
Right. So to some degree, you'll start to see some of the internals of the labor market kind of shift. The number of people quitting their job, for instance, will go down. It's been coming down a bit, but you'll see people not as willing to quit their job as they were over the last couple of years, when it was actually quite high, relatively speaking. And you'll see the number of job postings start to come down. You'll see employers and companies on earnings calls and things talk about slowing their hiring and not wanting to to reduce their wage costs. Essentially, we've seen a little bit of that, but overall not too much. But right now, the companies have gone through a long stretch of not being able to find enough workers. And so I think they're going to be hesitant to go rapidly the other way and start letting people go after having spent so much time trying to hire people. So I think it'll be a slower process this time, in part because of what happened after COVID. The number of people available to work has has been limited, and we're not allowing much immigration still. So I think there's still a certain lack of supply in the U.S. labor market, which will take time to kind of unwind. So I wouldn't expect it to happen too rapidly, but you'll start to see once people aren't willing to quit their job and employers start to talk about not wanting to hire so much, that'll be the first sign. And then you'll start to see the layoffs and the actual increase in unemployment.
Well, certainly if you see earnings being strong, like we did last quarter, relatively speaking, is there a relationship between earnings and the unemployment rate? Logically speaking, if earnings are strong, there's less of a chance that companies will be laying off in the next quarter or two, right?
Right. Typically, if companies are seeing, revenues and earnings steady or rising, they'll be less likely to want to cut employees. There's certain industries and certain areas where they might have overhired and they're going to be cutting back. But overall, I think in general, if business is relatively good, you won't see widespread layoffs. You'll simply see kind of rotation from one sector, one industry to another. We've seen that a little bit of that in technology and some other areas. But I think overall, you would not expect to see, widespread layoffs if overall business conditions are relatively good. And so far, it looks like they still are.
One more indicator I'd like to bring your attention to, which is the Consumer Sentiment Index. There's a few different measurements of this. I'm looking at the University of Michigan Consumer Sentiment Index, and I've noticed that going back to the early 80s, there's been a pretty consistent relationship between the sentiment falling and then a recession hitting several months later. This has been true for 2008, and then during 2020, it was falling coincidentally with the 3-month recession that we had during 2020. Now, after that, it's been falling steadily, and yet we've seen no recession yet. Are you surprised by this?
Well, not really, no. And I think a lot of it actually comes down to the way some of those sentiment surveys work. And there's actually been some research, I think actually by the University of Michigan, that there's a large degree of partisanship that shows up in the survey responses. When you ask people how they think the economy is doing, you get a different response based on whether they're a Democrat or a Republican and who's in office in the presidency at the time. So you'll see big shifts around elections that have nothing to do with what's going on in the economy. You also see a big gap between if you ask somebody, how is your personal finances doing versus how you think the economy is doing or everyone else's finances. Most people will say their own, job or their finances are doing fine, but they think the economy is doing poorly. And there's a very wide gap there. So some of it is the way consumers respond to surveys. They don't necessarily reflect their own personal experiences. They reflect what they see in the news or how they interpret things politically. And so you've seen consumer sentiment be much weaker than you would normally think it should be, given that most people have a job, most people are getting raises. The conditions are actually relatively good for the average person statistically overall, but there's not showing up in the surveys for other kind of, I guess you call them psychological reasons or political reasons. So I've been tracking that for a little while now, and that's something that's been going on for probably 15 or 20 years, but it's really accelerated the last probably 10 or 12 years.
All right, so let's talk about your preferred sectors now, putting all this together. Which sectors do you think will do better this year?
Right. So I've been overweight areas like industrials, technology, consumer discretionary, and more recently looking at consumer staples. Also like the communication services to some degree. The kind of the tech kind of growth areas, particularly the larger caps, as well as some of the cyclical parts of the market. So industrials and parts of consumer discretionary. Which a lot of people think is unusual simply because if you expect a recession or you think the Fed tightening is really going to be the driver, you wouldn't buy cyclicals, right ahead of a recession or in the Fed tightening. But they've actually had some of the stronger revisions in terms of earnings estimates. And so they've had good fundamentals. They've actually been outperforming in a lot of ways. And so that's where I've been looking. I've been kind of avoiding energy and materials to a large degree. The financials, of course, weakened in March and are still under a lot of pressure. And things like real estate REITs have been more mixed lately, but have been under pressure from the commercial real estate struggles. So those are areas I've been kind of avoiding, along with healthcare. There's a lot of parts of healthcare that are still relatively weak. So I would say keep a cyclical tilt, but more kind of growth in industrials and consumer stocks is where I'm looking now.
A cyclical tilt. Interesting. Do you think that defensive sectors have, in economic downturns, a little more power, so to speak, because their products, if you take a look at food, for example, or staples like toiletries, these are things that have very low price elasticity. So even if prices stay sticky upwards, people will still buy them. And so that could make a good investment case.
Yeah, you're right. I mean, certainly areas that are, defensive, the kind of staples, things that people are going to buy no matter what, hold up better in recessions, and that's certainly what people go to when the market turns down or the economy turns down. The consumer staples, utilities, to some degree, some parts of healthcare, things like that are where people go for kind of their defensive exposure. So the one area that's looking better now in that kind of realm is consumer staples. We've seen some of the food products makers, beverages. And some of that I think is more pricing power, like we were talking about earlier. They've been able to raise prices faster than their underlying costs have gone up, and so their margins are looking better now, rather than sort of in anticipation of a recession. But whereas utilities and parts of healthcare and certainly real estate are not, nearly as strong right now. So I would probably not look to them just yet. But if you really think a recession is coming, then yeah, you want to be in the defensive areas.
Well, what's your view on real estate, commercial and residential? Are they both in trouble? Like some people have said. Elon Musk, for example, tweeted not too long ago that commercial real estate is going down, and then residential real estate is next. I'm paraphrasing, but I think that's what he meant.
Yeah, I think certain areas of commercial real estate, office buildings and things like that, have been under pressure and will probably stay under pressure for a while longer. There's still a lot of adjustment there to the kind of the post-COVID norm of people not being, in offices as much, and just the demand for office space in a lot of areas has weakened. I think other parts of real estate, certainly things like hotels and resorts, are doing better now, and in terms of commercial real estate, and in terms of residential real estate, I think it'll probably hold up better than people are expecting. I certainly think the housing stocks are telling you that the housing market is doing better than most people anticipated. I think there's still a fair amount of pent-up demand for housing. There hasn't been enough building to keep up with it so far, and people are managing to work around the higher mortgage rates. I think the interest rates are really hurting the commercial side, where demand has been much weaker than it has been for residential. So residential will slow down eventually, and I think the price increases have stopped, but I don't think they're going to fall off a cliff the way they did in 2008 or something like that. I think it'll be more of a slow kind of moderation rather than any kind of dramatic move. But commercial real estate, office buildings, I think are still struggling right now.
People have been saying that household formation in the U.S. is still strong, and that at least because of that, the single unit family homes will still see strong demand. I don't know where they're looking at the data for this, and certainly I'm not disputing that, but I'm looking at the average age of marriage, for example, and the average age of childbearing from women. And that's been steadily going up, not just in the U.S., but all G7 countries, industrialized countries. I just don't see a scenario in which household formation is booming right now because people are getting married and forming households and families later on in the life. Do you agree or disagree with that?
No, I think you're right. I think in general, the demographics are for people having children later and having fewer children. The number of children per person or per couple has been going down. I think in the U.S. it's somewhere near the replacement rate of 2.1, but in a lot of other developed countries it's well below that. And in China I think it is as well. So I think there's definitely a sort of a slowing in the long term kind of secular demographic trends. I think there's probably been a rebound lately in household formation after COVID, just because of people kind of moving in with their family during COVID or just before. Some of that is reversing as people are more willing to get their own place and things like that. But I think that's more of a shorter term cyclical activity rather than a longer term secular thing. But I think you're right that the general longer term trend has been kind of towards slowing growth in the population and the aging of the population, which will tend to reduce household formation overall. So it's just a matter of year by year it'll fluctuate, but overall it's probably slowing.
What does that mean for housing starts and home builders' priorities in the following years, if not decades?
Yeah, I think it's a question of the demand for housing and where the housing is. Certainly, you could build houses lots of places. It's just a question of where people want to live and where they can live. So I think some of it is going to be driven by the demographic trends, and that as baby boomers who are getting to retirement age now start to downsize and move out of the homes they used to live in and into smaller houses or apartments and things like that, that will affect things over the longer term. I think a lot of people still want to own their own home, but I think it's the fact that the cost has gone up, both in terms of financing, but also in terms of the cost of a house, will limit it to some degree. So, and then there's also just the fact that there's a lot of regulatory limits on how much building can be done. Even if home builders were willing to build twice as many houses, if the government, local state governments won't let you, then it doesn't get built. And certainly other countries have dealt with that as well. And I think there's a lot of limitations there in terms of housing, in terms of what's being allowed to be built versus what the market might demand.
Fair enough. All right. Well, thank you very much for your time today, Sam. Where can people learn more about your work?
Sure. Well, certainly millstreetresearch.com has example research, has a lot more description of what I do, and certainly follow me on Twitter at Mill Street Research. I usually post there pretty regularly, commenting on the economic data, earnings, price action, lots of things. So if you want to get a feel for it, that's a good place to start.
All right. Thanks very much, Sam. Appreciate it.
Thank you.
And thank you for watching. I'm David Lynn. Stay tuned for more, and don't forget to subscribe.